Every time prices rise, you lose a little more of your freedom. Groceries, rent, gas, they all inch higher, month after month. And if you've ever felt like your paycheck just doesn't stretch the way it used to, you're not imagining it. You're watching the quietest transfer of wealth in human history, one that repeats every generation. Because inflation doesn't just make things more expensive, it steals your financial future. Welcome to the Wealth Casebook, where money, power, and history collide. And nothing is ever as simple as it looks. For most people, inflation feels like chaos, prices out of control, savings eroding, your paycheck stretching thinner. But for the powerful, inflation is order. It's how the modern economy keeps itself alive. It's how governments pay for wars without raising taxes. It's how corporations erase their debt. And it's how the wealthy watch their assets multiply while everyday Americans scramble to keep up. The question isn't why inflation happens, it's why it is allowed to happen again and again. To understand that, you have to go back to a time when inflation was treated like a national emergency, not an economic target. In the early 20th century, most major economies were tied to gold. Every paper note was backed by metal stored in a vault that made money scarce and stable. Governments couldn't print their way out of mistakes. If a country ran a deficit, it either raised taxes or admitted defeat. Inflation, when it happened, was usually the product of war or collapse. A loss of discipline. The idea that a government could choose inflation on purpose would have been unthinkable. But then, everything broke. The Great Depression in the 1930s shattered the illusion of monetary restraint. Prices fell, wages collapsed, banks failed. The economy froze, not from inflation, but deflation. When money gained value over time, nobody spent it. Debt became heavier by the day. It was an economic death spiral, and it changed everything about how policymakers thought about money. By the end of World War II, inflation had transformed from a fear to a tool. Governments emerged, buried under mountains of debt, some owing more than 200% of GDP. They couldn't pay it back honestly, so they didn't. They let inflation do the work. Through the 1950s and 60 segundos, global debt quietly shrank, not because nations grew richer, but because the value of debt melted away. $1 trillion of war bonds didn't mean the same thing 10 years later. The system learned a lesson. Moderate inflation could solve impossible problems without anyone noticing. Then came 1971. President Nixon closed the gold window, ending the dollar's convertibility to gold. It was supposed to be temporary. It became permanent. In that moment, money stopped being a measure of value and became an instrument of policy. For the first time, the world's dominant currency wasn't backed by metal, but by confidence. You couldn't exchange it for gold anymore, only for more dollars. Inflation was no longer a symptom. It was a design feature. From that point on, the rules of the game changed. Money could be created in infinite quantities, as long as people kept believing in it. Governments could borrow without limits. Banks could expand credit endlessly. Investors learned that as long as inflation stayed managed, the real winners weren't savers, they were borrowers. Inflation quietly flips the logic of money. If you hold cash, inflation robs you. If you hold debt, it rewards you. Every year that prices rise, the real value of what you owe goes down. $1 million mortgage today might feel crushing, but in 20 years after steady inflation, that same debt feels lighter. Meanwhile, your assets, your house, your stocks, your retirement accounts all rise in nominal value. Inflation doesn't just shrink debt, it amplifies wealth. That S, the paradox, at the heart of the system. The same force that destroys the everyday worker sustains the rich. And it's not a conspiracy. It's arithmetic. Inflation is the mechanism that lets a debt-based economy survive. Without it, every dollar owed would have to be paid back in dollars that hold the same value they had when borrowed, an impossible task when the system is built on credit expansion. Governments, central banks, and corporations quietly agreed. Better to let the currency lose a little value each year than let the system collapse entirely. But what happens to the average American in this arrangement? The answer is simple and devastating. Wages rarely keep up. Prices rise faster than paychecks. Savings once the cornerstone of middle-class security, become a slow-motion loss. Those who rely on earned income rather than assets find themselves running on an invisible treadmill that never stops. Inflation rewards ownership, not labor. It punishes caution, it turns trieft, on say a virtue into a liability. The system tells you to save, but penalizes you for doing it. When your bank offers 3% interest but inflation is 6%, you're not earning, you're losing. Meanwhile, Americans who borrow at 4% to buy property see their asset values climb by double digits. That's not market luck. That's the design. Inflation doesn't redistribute money randomly. It redistributes it upward. The people closest to the source of money, banks, governments, corporations, get it first, while it still holds value. By the time it reaches you, it's already done. It's called the Cantillon effect, named after an 18th century economist who noticed the pattern 3 centuries ago. When new money enters the system, it benefits whoever touches it earliest, before prices adjust. Back then, it was kings and merchants. Today, it's hedge funds and central banks. Inflation doesn't just change prices, it changes who gets to live above them. After 1971, the logic of money flipped for good. What once punished overspending now rewarded it. What once disciplined governments now liberated them. And as credit replaced savings, inflation became the quiet glue that held everything together. For Americans, the 2008 financial crisis should have been a reset, a chance to rebuild something fair. Instead, it became a masterclass. In controlled inflation, central banks created trillions in new money to rescue the system, not by giving it to everyday citizens, but by pumping it into banks and financial markets. Asset prices recovered overnight, stocks and property soared. Wages did not. Quantitative easing, the technical term for printing money through bond purchases, made it sound like a technical fix. It wasn't. It was a historic redistribution of wealth through asset inflation. Those who owned thrived. Those who rented waited. It wasn't corruption, it was policy. Then, in 2020, the cycle repeated, this time under a global pandemic. Governments injected money directly into households to avoid collapse. Demand surged while supply chains broke. Inflation hit levels Americans hadn't seen in 40 years. Once again, history rhymed. The stock market hit record highs. Real estate became unaffordable. And the same people who benefited from low interest rates now profited from scarcity itself. For a moment, the public blamed greedy corporations. But it wasn't new greed. It was the same greed the system had rewarded for decades. They were just better at the game, because inflation doesn't choose its winners. It amplifies whoever already has leverage. Look at any major inflationary period in history, and the pattern repeats. In Weimar Germany, the middle class lost everything, while industrialists with real assets grew richer. In post-war Britain, inflation quietly wiped out the national debt, while savers saw their pensions eroded. In 1970s America, stocks stagnated, but real estate and commodities made fortunes for those who could afford them. And in the 2020s, the richest 1% gained trillions, while the median household fell behind. Different eras, same formula. Inflation is the oldest wealth transfer on earth and the most structured one. The public blames greed, politics, and supply chains. But those are symptoms. The root cause is structural. The economy depends on credit expansion, and credit expansion requires inflation to survive. The alternative isn't stability. It's collapse. Even when central banks talk tough about fighting inflation, their real mission is never to eliminate it, only to control it, to make it feel like stability while the value of your money quietly erodes. If inflation truly went to zero, growth would stop. The economic machine would seize. And so, the war on inflation becomes a performance, a delicate dance between credibility and necessity. The Federal Reserve raises rates, markets panic, and then, just before something breaks, the tide turns. Because deep down, everyone at the top knows. A little inflation is a small price to pay for keeping the illusion alive. There's something deeper than policy here, something psychological. Inflation doesn't just change numbers, it changes behavior. It teaches Americans to consume now rather than plan for later. It punishes patience. It rewards risk. It turns saving into fear and speculation into hope. In doing so, it creates the perfect citizen for a debt-driven system. Always spending, never satisfied, and perpetually chasing financial security that can never quite be caught. That's how inflation becomes a culture. We call it growth. We call it prosperity. But underneath, it's the same mechanism that has been running for centuries, a quiet cycle of devaluation, reinflation, and rediscovery. It keeps empires solvent, banks liquid, and the public docile. And once you see it, you can't unsee it. Inflation is not random. It's how power measures time. It rewards those who live in the future, the ones who borrow, invest, and manipulate the flow of credit. It punishes those who live in the present, the ones who earn, save, and spend carefully. And it forgets those who live in the past, the ones who still believe money holds its value. That's why the rich love inflation, and you don't. To them, it's not theft, it's strategy. Every generation learns the same painful truth. The value of money is never fixed. The only question is whether you're losing it or deciding what it's worth. Inflation didn't appear out of nowhere. It's the natural consequence of a society that wants everything now and pays for it later. It's the quiet engine of debt, the fuel of empires, and the lifeblood of a system that must always expand, even at the cost of Americans in the middle and lower classes. Yet here's the paradox. Without it, everything collapses. Deflation destroys borrowers, crashes banks, and freezes trade. Inflation keeps the gears turning, no matter who gets crushed in between. That's the moral equation of the modern economy. Growth at any price. So the next time you hear a little inflation is good for the economy. Remember who it's good for? Not the worker saving for a home, not the retiree living on a fixed income, but the ones who already own property, stocks, and businesses, the ones who built the system to make sure it never stops rising. Inflation isn't a glitch in capitalism. It is capitalism running at full speed, uphill, with your wallet in its pocket.